From mid-July until the end of November, the utilities sector rallied very strongly, over 18% during that time, in fact. And this really is not surprising because there were at least three factors that were pushing it higher. However, since then, the sector has pulled back quite sharply in recent weeks. In this video, I'm going to talk about why it rallied so much, as well as why it pulled back sharply recently, and what my outlook for the sector is moving forward, as well as how I'm investing as a result. But before I get into today's video, if you could please subscribe to my channel, I'd greatly appreciate it. Thank you so much. Okay, so why has the sector rallied so much since early July until late November? Well, like I said, there are three big reasons why. First and foremost, it looked like inflation was on its way down. There are some very positive data points that came out that seemed to indicate that not only was inflation declining across the board, but that it was on its way to reaching the Fed's target rate in the not too distant future. And as a result, the market was growing increasingly bullish that the Fed was going to pivot to rate cuts, and not only pivot to rate cuts, but cut rates quite consistently and quite aggressively over a short period of time. And so as a result, long-term interest rates began to decline. And this was very bullish for utilities because of their stable, regulated cash flows. They're often viewed as a bond proxy by the market. They pay out attractive dividend yields that compete fairly well with long-term interest rates. They also, again, are very recession resistant because their business models are regulated. So it's basically a monopoly that they have on a region that they're given by a jurisdiction. And they even have growth on top of that. And so for those reasons, utilities became a more attractive place to invest money. Additionally, they're pretty capital intensive businesses. They invest in CapEx. To grow their businesses, they have to invest a lot of capital, often raise some debt to do that. And so again, interest rates are a tailwind for those reasons as well. Another big reason why utilities were becoming increasingly in favor is because there were growing concerns that the economy might enter a downturn. Unemployment was rising quite rapidly. Consumer and corporate debt still is at record levels, and there were growing concerns, especially given that some of our United States overseas trading partners were also facing some economic challenges. And so there was a bit of a flight to safety and incentive there, as well as people were increasing their allocation to utilities to increase the overall defensive posture of their portfolio. And the third big reason why utilities rallied so strongly was because of the AI boom. Now, obviously, the AI boom has been going on since 2023, early 2023, but it largely skipped the utility sector. So far, it mainly been the mega cap tech stocks like Meta, Amazon, Nvidia, Apple, Microsoft, Alphabet, Tesla, Broadcom, etc., and even some of the smaller players like Palantir, and even some of the non-regulated power producers like Vistra and Constellation Energy. But largely, the regulated utility power players had not benefited yet from it. But finally, the market woke up to the fact that this is going to be a big growth tailwind for utility stocks as well, because there's going to be this huge demand for electricity to power data centers, and that's going to give near limitless growth opportunities to a lot of utilities, especially those that are focused in markets where it's anticipated there are going to be a lot of data centers being built. So that's another reason why the utility sector appreciated so much during that period of time. However, it pulled back sharply really over the last 3 weeks or so. And why is that? Well, three big reasons. One, again, the interest rate outlook has changed. Recent inflation ratings have indicated that inflation really isn't declining. It's largely stagnated, and some readings even show it's slightly reaccelerated. Federal Reserve, in its latest dot plot, yes, they cut rates by another 25 basis points, but their dot plot for next year indicates that they're actually going to cut rates at a much slower rate than they previously indicated, and even Jerome Powell in his commentary indicated that they're going to take a very data-driven approach to deciding how they're going to go about doing rate cuts moving forward. Another big reason is recession fears have largely dissipated, and that's because Donald Trump won the election, and yes, there's some debate about his policies, especially tariffs, what kind of impact they're going to have on the economy, although most think that that's more inflationary than recessionary impact, and so, of course, that goes to the first point I just shared. But also, he's going to have very pro-growth policies based on his first term and the people he's putting around him, much lower regulations, downsizing government, potentially even eliminating some departments, or at the very least dramatically rolling back their scope and their budgets. And so that's generally viewed to be a more pro-growth atmosphere. So again, recession concerns have fallen back. Third big reason why they've pulled back recently, again, is just simply due to valuations and some pause about the AI boom. Again, the AI boom is still going on. People are still bullish as ever about it, but some of the big mega cap tech players have kind of peaked. For example, Nvidia hasn't really done much with its stock price recently, and the market is starting to move into show me mode. And with the utilities in particular, there are concerns just again that will they really be able to deliver on this growth relative to where the valuations have gotten built up. So it really is just a market pause, people locking in gains. And so when you combine those three factors, that largely explains the pullback that utilities have had recently. And again, keep in mind they're still well above where they were before they began the rally in July. Okay, so how am I investing as a result? Well, before I get into that, if you could please give this video a like, I'd greatly appreciate it. Help in its distribution. Thank you so much. Okay, so how am I investing? Well, I'm not abandoning the utility sector. In fact, on the recent pullback, there are certain utility-like stocks that have gotten really hammered that I think are really compelling buys right now. For example, Brookfield Renewable Partners, Brookfield Infrastructure Partners, both that I really like right now. They've gotten hit hard, especially Brookfield Renewable Partners I like a lot. It's one of my highest conviction buys actually for the next year. Now they both issue K1s. I know many of my audience doesn't like that. There are 1099 alternatives. The BEPC ticker symbol for BEP is the C Corp alternative. BIPC ticker symbol for BIP, that's the C Corp alternative for that one. They both issue 1099 tax forms. So, you can always take advantage of those. Again, I'm not completely abandoning the strict utility sector either. I like ATCO right now. I think is pretty good on the pullback. That's one that I like a lot. It's an Alberta-focused utility, but again, you may pay taxes to Canada on them if you're a U.S. investor. If you hold it in an IRA or 401k like I do, I don't have to do that. Again, this is not tax advice. This is just my opinion from my personal experience. But how else am I investing? Well, I am taking these growing headwinds, especially the interest rate concerns, to heart as I allocate capital. So another sector that I like is the business development company sector. Now, I had some videos earlier on this past summer where I was growing increasingly cautious, and I was actually moving out of BDCs and going into utilities and utility-like stocks more aggressively then. And then the market flipped. Utilities began to significantly outperform BDCs just as I expected. And so lately I've been shifting back over the last several weeks to more heavily weight BDCs because, again, it looks like we're going to have short-term rates are not going to be cut as fast as previously expected. That's great for BDCs because their investments are heavily indexed to short-term interest rates. So that means their income will not be being pinched as much as I previously thought. If the economy remains on sound footing, that means fewer non-accruals and defaults in their loan portfolios, which is also very good for BDCs. And so I think if you can still invest in high-quality, defensively positioned BDCs, you get a very nice risk-adjusted investment profile right now that kind of balances out the utilities because between the two, you're defensively positioned against any downturns in the economy. But in terms of where the rate environment goes, you're pretty well balanced. If rates end up going lower than expected, utilities are going to outperform. If rates end up being higher than expected, BDCs will probably outperform. So it's nice to balance between the two. Utilities are a little more growth-oriented. You still get a decent yield, but more growth. BDCs are lower growth, but higher yield. And so you balance the two. You get really a pretty good yield between the two, and you get decent growth. So I think balancing between the two, and there are other sectors you can throw in there as well that I mentioned, like midstream, REITs, and some others. But again, these are two in particular that I think have a nice trade-off in the current environment especially. And so I'm investing in BDCs. I've shared many of those with you guys in the past. Some of my favorites are Morgan Stanley Direct Lending because almost their entire portfolio is invested in senior secured loans, mostly first lien. They have very low management fees for an externally managed BDC. They traded a pretty attractive valuation relatively equal to their net asset value. Despite being one of the highest quality BDCs out there, they have a very attractive double-digit dividend yield that's well covered by net investment income. They have an under-leveraged balance sheet that should be growing its leverage, which will further boost their net investment income and make their dividend even safer and possibly even lead to some special dividends next year. Insiders, which the external manager is Morgan Stanley, they own over 10% of the equity in MSDL, and so they're well aligned with us, the shareholders. So that's another reason I really like MSDL. Another one I like a lot right now is Golub Capital BDC, and that one is also heavily invested in senior secured loans, has a very good external manager in Golub Capital, very reputable, have a pretty good long-term track record of sustaining the dividend, and they have a solid balance sheet. In fact, one of the best credit ratings, especially outlook adjusted credit ratings in the BDC sector, very well covered dividend, a strong portfolio with low non-accruals, just like MSDL has, and they have an even lower expense fee structure than MSDL, although they both are very close. GBDC slightly edges them out on a few things. And so again, I really like them. And also they're pretty cheaply valued as well. So between those two, I feel like you're getting high quality, very attractive valuation compared to some of the very richly valued BDCs in the space like Main Street Capital, Aris Capital Corporation, Blackstone Secured Lending. All great BDCs, but trade at hefty premiums to NAV. Whereas with these guys, you get almost as good a quality, still very compelling fee ratios, and strong portfolios, very attractive dividend yields, very well covered dividends, yet you're not paying this huge premium to NAV, and so there's more downside protection in case the market gets very bearish on BDCs and they plunge in their price to NAV ratios, which we've seen in past market crashes where even the likes of Main Street Capital and Aris Capital Corporation, their price to NAV ratios plummet. And so I think we're more guarded against that by investing in those companies. So again, hopefully this video was helpful to you. If it was, again, please give it a like, subscribe to my channel. Let me know in the comments below what you enjoyed about it or what you'd like to see in future videos. Thank you so much. See you next time.